Wall Street traders are not the only ones that are anticipating a Fed funds rate cut. Mortgage lenders are also hoping for some love from the Federal Reserve, our central bank, as well. The 10-year constant maturity treasury rate, of course, is the index that the reverse mortgage lender watches closely, as it determines in part the starting principal limit or the available loan seeds a borrower may qualify for in a home equity conversion mortgage. The good news is while the Fed funds rate doesn't closely match the 10-year CMT index, it does somewhat track with the Fed's key short-term interest rate, the Fed funds rate. So how will reverse mortgage lenders respond should rate cuts materialize? The opportunity is actually twofold. One is to qualify borrowers who may have been short to close, and secondly, by attracting new borrowers. Housing Wire's Chris Clow interviewed a few notable industry leaders in a recent edition of Reverse Mortgage Daily, which can be found on Housing Wire. The prospect of interest rate cuts on the horizon can be a win-win for many homeowners who have been waiting on the sidelines, and for the reverse mortgage industry, said Finance of America President Kristen Seifert. Importantly, she added, it can help qualify more people through ability to access additional levels of valuable home equity. David Peskin, CEO of High Tech Lending, says, as the 10-year expected rate drops, many of these potential borrowers can likely qualify for a reverse. As an industry, I hope we take advantage of lower rates across the board and look to grow the industry and not to simply recycle it. The recycling that Peskin refers to is HECM to HECM refinances, which did boost HECM endorsement volumes in the years which followed the COVID-19 pandemic and interest rate cuts. At its peak, HECM refi transactions accounted for 51% of endorsements. What suffered during this time was attracting new first-time HECM borrowers, that is, growing our industry. Rates Reverse Mortgage Division Leader Ryan Ogata takes a balanced viewpoint of a potential rate cut for reverse mortgages. There's some nice revenue to be had as a result of refis, but I'm not worried about rates coming down, said Ogata. It will benefit us, and eventually rates will move in the other direction. That's the cyclical nature of the mortgage business, both on the forward and on the reverse side. While lower interest rates do increase the appeal of the home equity conversion mortgage, or the HECM, they also reduce the amount of cash that a short-to-close borrower would be required to bring to the table. Now, this shortens the time that the borrowers would recoup the lump sum payment that they bring to closing by eliminating their monthly mandatory mortgage payments. Last week, Normala posted an excerpt from a recent Kiplinger column, which explores the potential benefits of using a reverse mortgage to settle a gray divorce. The columnist, Andrew Hatherley, is a chartered retirement planning counselor and also a certified divorce financial analyst who is well-versed in such matters. Hatherley writes, the subject of reverse mortgages is often met with skepticism from clients. A person going through a late-life divorce might even be perplexed on how a reverse mortgage might help offer a potential solution to the financial stress of divorce. What did change his mind? Well, working with certified divorce lending professionals, or CDLPs, and older divorcees who showed the value of utilizing a reverse mortgage to help iron out some of the more common problems that are encountered when older couples are divorcing. And the value of a reverse mortgage in a gray divorce really boils down to a source of funds to help settle the division of property. Now, Hatherley explains, divorce usually involves dividing assets, including the marital home. Reverse mortgages allow older homeowners to convert part of their home equity into tax-free cash, and that helps divorcees who are needing liquid assets to buy out their spouse's share of the marital home, or to help fund new living arrangements without having to sell the home. The proceeds from a reverse mortgage can help to supplement income, helping to cover living expenses and healthcare costs. Chris Bruiser, a reverse mortgage specialist with Mutual of Omaha Mortgage in Tampa, notes, a divorced person may have had their net worth cut in half in divorce. The HECM helps preserve those investment assets by eliminating mortgage obligations. Those assets can be used to generate income from investments. The columnist summarizes the two most common uses of a reverse mortgage in a silver or gray divorce as follows. First, If the marital home does remain with one spouse, a HECM on the marital home could provide the necessary funds for the departing spouse to make a down payment on a new home. Second, the marital home, if it's sold, in that case, the proceeds would be divided. Then each spouse could use their share of those proceeds from the divorce toward a down payment on a new home purchase using a HECM for purchase to pay the balance. John Drennan, a certified divorce lending professional with VIP Mortgage in Las Vegas, says a more creative option where one spouse purchases a duplex or fourplex with a HECM and lives in one unit and then rents out the others to boost their cash flow. A good point. Reverse mortgages may not be the best fit if either homeowner plans to shortly move or to leave the home equity to their heirs, but reverse mortgages do have their application and value in many great divorces, and this is just one example. And our last story this week may serve as a very important discussion point with potential borrowers. When banks and lenders find that home prices are uncertain or they anticipate an economic recession, they quietly stop offering home equity lines of credit, or HELOCs as they're more commonly known. In fact, Chase and Wells Fargo Bank are just two of the more notable lenders that have already stopped offering HELOCs just last year. Now, yes, homeowners may qualify for a home equity loan or even a cash-out refinance today, but many industry watchers caution that HELOCs will become increasingly difficult to obtain in the coming year. As economic conditions worsen, the risk of a borrower default increases on that loan. For example, if a homeowner does lose their job in a recession, then it's very likely that they're going to be unable to continue to make payments on their HELOC. And HELOCs have attracted many borrowers for their lower closing costs, as they don't require many of the traditional closing expenses that you'll find in a traditional cash-out refi or a home equity loan. Also, the borrower only borrows what they need when they need it, and that keeps the balance lower, versus a home equity loan, which begins accumulating interest on day one. Unfortunately, most consumers are completely unaware of the risks that are associated with a home equity line of credit. And the first is, loan payments are going to be much lower during what is known as the draw period, and that's usually the first 10 years of the loan. Now, during that time, the homeowner can get draws from the equity line of credit, but they're going to be required only to make interest payments. However, after the draw period ends, many homeowners may experience payment shock. That's because the payments become fully amortized for the interest and principal that's outstanding, and those payments could be for a period which typically lasts about 20 years. Now, hell may never freeze over, but HELOCs can and have. Lenders do have the option to freeze or reduce the line of credit in an uncertain housing market or economy, especially if home values are falling. And that was one of the biggest lessons that HELOC holders learned during the great financial crisis and housing crash of 2008 and 9. Now, you can't count on a HELOC when you may need it the most, and that's a lesson to take home. Now is the time for reverse mortgage professionals like those of you watching right now to reach out to traditional lenders in your community that are offering HELOCs. Older homeowners who may not qualify for the loan could find value in the HECM's line of credit, which cannot be frozen or reduced merely due to market conditions. And even better, the line of credit in a HECM will likely increase over the years as home values are even falling. And that concludes this week's edition of HECMWorld Weekly, the nation's only weekly podcast bringing reverse mortgage-related news to you, the mortgage professional. We do have an audio edition. If you're not always able to sit down and watch, that's fine. You can listen in your car or at the gym. You can find our audio podcast on Apple Music and Spotify and Podbean. Thank you for joining us, and be sure to return next week for more reverse mortgage news you'll only find here at HECMWorld. Have a great week.